Ladies and gentlemen, it is my strong belief that NIO, or NIO, or whatever you want to call it, the Chinese electric vehicle company, is going to take over the entire world. And here's why I think that, ladies and gentlemen. Because I went and looked at the company's financials, which I know a lot of you YouTubers, you clowns, you dorks, you don't care about financials. All you care about is something's an EV company and EV's the future, therefore you should buy it. Well, guess what, ladies and gentlemen? If you don't do your due diligence and read the financial statements and read what the company's management is telling you and looking at the company's profitability, margins, if you don't do any of that, you're going to fail in the long term as an investor. I don't care if stonks went up recently. It doesn't matter to me. What matters is the long-term viability and profitability and competitive advantage of the industry that you want to invest in. Now, to start this off, I pulled up NIO's unaudited first quarter 2021 financial results. And this company, ladies and gentlemen, in the first quarter alone of 2021, has delivered 20,000 vehicles. Now, that seems like a lot. And you can see how the company's growing. I mean, last quarter, it was 17,000, then it was 12,000 and 10,000. So, I mean, they're increasing their production. They basically almost doubled the amount of sales in the past year, which, okay, cool, growing company. But here's the thing, ladies and gentlemen. This stock's market cap is like, what, 64 billion, which is pretty freaking big, okay? Now, compare this 20,000 right here. Hopefully you can see it. I'll zoom in for you blind people. They delivered 20,000 cars in the first quarter. So let's be generous and say they are going to deliver 100,000 cars throughout 2021, okay? Because they'll probably keep growing how many cars they're selling. Let's go look at the global market of how many cars are projected to be sold in 2021. Is that 70 million cars? So let's see what percent of cars NIO is going to be selling. How much of the world are they going to control? So we take 100,000, which is our projected sales for 2021, and that's being generous. I mean, they might meet that. We'll see. Divided by 70 million. Ooh, 0.14% of the world's sales may potentially be NIO's. Now, ladies and gentlemen, that is an incredibly dominant car company. I'm going to stop to spit into my spitter. Now, let's go look at some of their financials some more. Okay, so right off the bat, they're growing their sales, which is nice. You know, that's cute. And they actually have a comparison to the prior years. So they've been growing consistently. That's not a bad thing for a company. But it's more than just revenue growth. You have to look at gross margin, operating margin, net margin, cash flows, free cash flow, their balance sheet. You have to look at all that stuff to really understand that this company is going to be viable in the long run. So they have some highlights. Okay, blah, blah, blah. Vehicle sales. Vehicle margin was 21%, compared with a negative 7.14% in the first quarter of 2020. Now, vehicle margin is simply the sales price of the vehicle minus all the costs that went in to make the vehicles. And we're not counting, like the salary of the CEO or stock options. Only certain costs are used to calculate vehicle margin. So just think of it as how much did it make to make the vehicle versus how much they sold it for. Now, it's actually a positive sign that vehicle margin improved from negative 7.4% in the first quarter of last year to 21%. That's actually a good thing for the company. Does that mean you should go buy the stock? No, it doesn't. Because you have to discount the future cash flows of the stock or the projected future cash flows at your required rate of return. And just because a stock or a company is growing doesn't mean you buy it. All right, total revenues, they've gone up pretty significantly. That's not surprising because they've been, rapidly expanding the amount of cars they're selling. Gross profit was increased by 32%, okay? Gross margin, loss from operations, cool. So, right off the bat, the company's growing, whatever. Let's go look at some of the information that the management is telling us about some of the risks of this car company. Because there's a lot of risks for a brand new startup company that's been running a lot of losses. So you want to go into their 10K, their annual financial report, and at a minimum, read about the business model, read management's discussion and analysis, and then look over the financial statements to see trends and changes in balance sheet items, revenue, margin, etc., etc., etc. That's all important. So let's look at some of the key information here. Okay, they have some consolidated sales data, but we'll actually go look further in the financial statements instead of looking at that right now. All right, cool. Now, here's important, ladies and gentlemen. Every investment has risks. Every investment. Even the greatest company in the world, there can be risks because companies have competition, and there's lots of things that can go wrong with a company. Now, NIO is such a new company. It's only been around for since 2014, and it went public 2 years ago or 3 years ago. It's a pretty new company, and it's actually not selling that many cars. It is a very small fry in a big pond, and there's lots of competitors entering the EV scene, including a lot of the legacy automakers. Now, since NIO is based in China, maybe they'll have an edge over foreign car companies because China can just slap a tariff if they want on any cars that are imported. Of course, that would lead to retaliations, but whatever. So, NIO may be able to survive, but in my opinion, it's too early to tell. But you should read some of the risk factors, okay? And they list them all right here. You need to understand what could go wrong with this company. So just going down the list, we have not been profitable and have only recently started to generate positive cash flows from operations. Now, that right off the bat tells me this company's way too new and speculative to invest in. You want to see profits and consistent profit growth to even consider investing in a company. Now, that doesn't mean that if you invest in this company right now, that you may not realize a profit, 5, 10, 15 years from now. I'm not saying that. What I'm saying is you're going to be better off investing in companies that are consistently profitable and have demonstrated abilities and have been able to establish a wide moat, which right now, it's not profitable. They don't have any moat. There's massive competition, and they only recently started generating positive cash flows from operations. That's not very enticing to me, okay? I don't care what the YouTubers say. I don't care what these clowns like Chris Sane and what's his freaking name? Whatever, Keenan Grace and whoever's pumping NIO. It doesn't matter. You need to look at the financials. All right, so they haven't been profitable. Their business may be adversely affected by COVID-19. I think a lot of businesses were. We have a limited operating history and face significant challenges as a new entrant into our industry. Yes, there's a lot of risk that even though NIO may do well, they may do well in the future. You need to understand that you're speculating that this one car company is going to rise and dominate hundreds of competitors. How many freaking car companies there are? So I would not put a lot of your portfolio on this company. But if you want to speculate on it, some of their financials are improving, which is, a good thing. But there's also a lot of risk that you may not succeed. You may get hurt. All right. Let's see. Manufacturing collaboration with our partners. Okay, that's probably everybody. Blah, 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 blah. Blah, 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 blah. Our vehicles may not perform. Okay, that's anybody. Power solutions. Providing the battery as a service. Blah, 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 blah. There's something else I saw on here. The automotive market is highly competitive, and we may not be successful in competing in this industry. Now, what's going to happen, ladies and gentlemen? There's going to be all these startups that are going to pop up. Oh, we're an EV company. We're going to change the world. We're so amazing. But 10, 20, 30 years from now, a lot of those companies aren't going to exist. And NIO really faces that risk that they won't be able to keep up with the competition. It doesn't matter if it's EV and exciting. It may be crushed by its competitors. It's too early to tell. So that's some of the risks, which, cool. Okay, let's go look at the financial statements. So we go to the 10K. Usually it's item 8. All right, I remember doing this earlier. I got there's 20,000 pages before it even gets to the financials. So click, 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 click. Blah, 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 blah. Look at all this crap, which you should be reading all this if you really want to invest in this company. All right, I think we're getting there. Come on. All right, here we go. Let's start by looking at the auditor's report. Now, it's very important to read the auditor's report because the auditors as much as you can trust them. They're looking at the company and they're basically saying if the financial statements are fairly presented in all material respects, which means that they looked at the numbers and they're basically accurate. Okay, so you want to read the financial or the auditor's report. Now it says here, in our opinion, the consolidated financial statements referred to above present fairly in all material respects the financial position of the company. Now, there are some risks because it's China and people are concerned that you can't trust the numbers, and there's some valid concerns. But at least it's reassuring that the auditor's opinion, for what it's worth, they at least said it is presented fairly, which is a good thing. You want to see an unqualified opinion. Blah, 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 blah. So that's good. Here we go. Now we're looking at the balance sheet. So the main thing to look for in the balance sheet is the current ratio, which tells you if the company's able to pay its debts in the short term. So you want to look at the total current assets, which in this case it's 46 million, and their total current liabilities, which is 14 million. So they have a good current ratio. So this company isn't going to go out of business anytime soon. Now they're sitting on a ton of cash. Look how much the cash increased. It went from $862,000 to almost $40 million in cash. Where is that from? It's probably from stock issuances and debt issuances. So if there's stock issuances, that means the company's diluting the current shareholders. And if there's debt issuances, then the company's basically taking out a lot of leverage to grow its operations. Not unusual, but you got to be careful and you got to consider that stuff. Oh, and I apologize. This is all in Chinese currency. These two numbers right here. The one on the far right is actually US dollars, or the converted amount. So, okay, the company's not going to go out of business. Let's see if there's any crazy changes in accounts. Long-term investments, nothing really significant. Current liabilities, trades and notes payable, that almost doubled because they need long-term financing. Operating leases. Okay, so I just see a lot of debt, but that's normal for a growing company, or growing debt. But overall, this company isn't going to go out of business within a year. That doesn't mean it's not going to go out of business in the future. So that's what I take from the balance sheet. You can do a lot more research into this, but I'm not super concerned about it dying tomorrow. So that's the balance sheet. Okay. Now we have... Okay, so on this page, they're going to more depth about the company's equity. And one thing that immediately stands out to me is growth in the number of shares. Whenever a company issues shares, it dilutes the ownership of the current shareholders. You don't necessarily want to see the number of shares increasing. I know it's a new company, but if you get in now and they keep issuing shares, your ownership is going to be diluted and diluted and diluted. So just right off the bat, looking at the A class or Class A shares, it went from 1,347, okay, that's millions, to 2 million, 2.2 million. So the shares outstanding have almost quite doubled, which is a pretty big increase in shares. So if you bought shares at the beginning, you've already been diluted very significantly. So you want to look out for share growth. Okay. Then we have accumulated other comprehensive loss. Don't worry about that. Well, I mean, it matters, but not for this. Accumulated deficit. Now, your accumulated deficit is basically your profits or losses stacked up on each other. So in US dollars, this company has almost $8 million of losses in the hole. This company just saw a profit. They've been having losses for the past couple of years. So they're pretty deep in the hole. It's going to take a long time for them to really come out of that, unless they explode. So that's pretty, okay. So right off the bat, shares are growing significantly. They're deeply in the hole, and it's going to take a while to get out of it. Let's see the income statement. Now, what I liked about this income statement, and I did a brief analysis of it, is that they've significantly improved their gross margin. Now, like I said, gross margin we looked at the other page, that was just the sales price minus the cost to make the car itself, not including research and development, selling and general administrative positions, selling and general administrative expenses. Now, the gross margin in 2018, how you calculate that, and there's actually two things here. They have vehicle sales and other sales. I don't know what the other sales are, but they break it up by vehicle sales, for revenues, and cost of sales. Now, for vehicle margin, which is just primarily a vehicle country, you take the number for the vehicle sales, and this is in Chinese currency, almost 5 million, minus the cost of sales, which was almost 5 million as well. So right off the bat, they were actually selling their vehicles in 2018. Basically, they were paying more to build the vehicles than they were actually selling them for. So they have a negative gross margin in 2018, which was not good. But the next year, well, they also had a negative margin there. 7367, 113, minus 809, 6035. Now, the gross margin percentage was almost negative 10%. Now, what I liked was at least they improved their margins, because in 2020, they had 15 million Chinese currency units, whatever it's called, of sales, and their vehicle cost of sales was 13,225,770 divided by 15,182,522. So they significantly increased their margin, their gross margin, which is a good thing, because if you're not even making money on the vehicles without even considering other expenses, that's pretty freaking ridiculous. And then looking at the most recent quarterly report that we looked at the beginning, I mean, it looks like they're improving their margins, so I can't really ding the company for that. Now, this is primarily a vehicle company, so this is kind of like Tesla. People say, oh, it's not just a car company. Well, look at the number of sales for vehicles relative to other sales, whatever that is. It's bigger by a factor of 15 for vehicle sales. So if anybody ever tells you this is not a car company, they're full of crap. Not that I've heard that. All right, so gross profit, they at least turned a positive gross profit in 2020, but they still had an operating loss, which factors in their operating expenses, research and development, selling, general, administrative. They're still running operating losses, which means they also have a net loss overall. So you still want to look at the margins. So for example, you can take the operating loss divided by their total revenues, and that'll kind of tell you what their operating margin is, or it will tell you that. So let's see how their operating margin has improved. So their loss from operations in 2018 in Chinese currency units was 959,608 divided by 4852,470. So they had a almost 200% like loss on operating income, which is pretty significant. But it's a new company, I understand that. All right, so the next year they had loss from operations of 11 million. Got to make that negative. 11,709,000. And you can actually look this stuff up on like Yahoo Finance. You don't have to go and calculate this yourself. 7,824,904. So it went down from negative 200%. Now it's negative 141%. And then in 2020, let's see. Negative 4607, 64, 15,182, 522. Now it's negative 30%. So they're actually improving their operating margin as well. It's a new company, so it's not the end of the world. So I wouldn't be freaked out. I mean, they are losing money, but I wouldn't say this company is dead. They are improving all of their margins. All right, so you want to look at loss from operations as a percentage of total revenues. You want to look at their net loss, which they've been running losses every year on an accrual basis, and just kind of see, like, is this company improving its margins? Because if it was getting worse and worse and worse, I wouldn't even recommend this as a spec play, because you at least want to see improvement. So they're improving. They're still losing money, but they're improving. So that's basically what I get from that. All right, let's see here. Basic and diluted. Now, what they will give you is what's called basic earnings per share and diluted earnings per share. Basic earnings per share, you basically take the number of earnings for the company divided by the number of shares. I mean, there's some stuff that goes into it, but it's the net income minus preferred dividends divided by weighted average common shares outstanding. That's how you calculate basic earnings per share. Now, there's this thing called dilution. And what dilution means is there may be convertible bonds that come into the mix. There may be stock options, warrants. And if those are exercised, that would dilute the current common shareholders even more. So you want to look at basic and diluted earnings per share to kind of see how much you could potentially be diluted. Now, here they say net loss per share attributed to ordinary shareholders. So they say basic and diluted. So I guess they're not going to distinguish that until they actually have a profit. But I would pay attention to basic versus diluted earnings per share. If you see a vast difference, that means there's a lot of convertible securities that could potentially dilute you. All right, let's go look at statement of cash flows. Where are you? Here it is. All right, statement of cash flows. The things you want to key in are net cash provided by operating activities and net cash provided or used in investing activities, and then net cash provided or used by financing activities. Now, just looking right here, starting with financing activities, let me zoom in again. So we have net cash provided by financing activities. That's how the company raises money. They either issue debt or they issue stock to raise capital. Debt doesn't dilute the current shareholders, but you have to pay interest. Common stock issuances, they don't charge interest, but there's an expectation that the company will perform at a certain level, and on top of that, it dilutes the current shareholders. So if you look at net cash provided by financing activities, in 2018, 11 million Chinese currency units, then 3, and then boom, 41 million. So that's a pretty significant increase. So they're really issuing a lot of debt or equity to really raise money. Now, the biggest increase I see right here is this 34 million for financing activities, which is issuance of ordinary shares. So they raised 34 million Chinese currency units in 2020, which, like I said 1,000 times, dilutes the current shareholders. So that right there does not make me happy. All right, so let's go up and look at net cash provided by operating activities, which basically shows the company's profitability almost on the cash basis, because income statements are made on the accrual basis of accounting. The statement of cash flow shows where the actual cash is going. So they're two different things. So you look at net cash used or provided by operating activities. So they had a loss on a cash basis of almost 8 million in 2018. Then it went up, and they finally had a positive inflow of cash in 2020. So they're improving. I mean, at least they're showing positive cash flow for once. We'll see how they do going into the future. But I just don't like it. There's too much uncertainty with this company. They're not selling a lot of cars. You know, it's a highly competitive market. They just broke even, or they just started making positive cash flow from operations last year. It's way too early to invest in this company. But if you want to speculate, there is potential. This company could potentially grow into a massive car company, but you don't know. It's too early. But you can get mad at me and downvote my video. So that's that. And you can also calculate free cash flow, and that's how you would do your discounted cash flow analysis, or it's one way to do it. And what you would do is you take the net cash provided or used in operating activities minus capital expenditures, which is the company investing money in property, plant, and equipment. That basically says how much cash is left over after the company makes all its required purchases to grow to be able to pay out future dividends. So you want positive free cash flow. So you would take cash provided in operating activities, that's this 1.9 million Chinese currency units, minus purchase of property, plant, and equipment. That's called CapEx. So they actually, it looks like they have positive free cash flow too. But you want to keep an eye on that, because that's ultimately how, if you build a model, that's how you'll predict the cash flows, or be able to project the cash flows to know how much to pay for the company. So overall, I'm not a fan of this company right now. It's too early. It has potential, as does every business, but you want to see positive cash flows for, a couple years, and maybe even positive you want to see positive net income. You want to see consistent growth, and it's just too early to tell. So that's that, ladies and gentlemen. If you like this, please hit the like button, subscribe to my channel, tell your friends about me, buy my book, Stop Being a Broke Loser. It's on Amazon for $3, and y'all have a wonderful, delicious day.